Hello, welcome everybody to our latest webinar, Buying and Selling a Business, What You Need to Know, with Paul from ETC and Robin of Bermans. We will be taking Q&As at the end of the session, so if you'd like to pop them in the Q&A box on your screen, that would be great. Thanks guys, over to you.
Thanks very much, Sarah, and yes, good morning, everybody, and thanks for taking the time to join us this morning. Hopefully, you can hear me okay, and that you can see the slides on the screen. So, before we get into the meat of the session, I'll just give you an idea of what we are going to be talking about today. And what Robin and I have done is really tried to pull out what we think are four sort of key areas amongst really many areas in terms of getting ready for sort of corporate transactions. So initially, Robin will kick us off really just with a conversation around preparing for that transaction. That's a process that takes a long time, and I'm sure Robin will go through a lot of the key issues that you need to focus on. I'll then touch on one of what we think from a tax point of view is a key issue, is really kind of tying in those key employees that you might have in your business, the people who help you create the business create the value rather by using share schemes, and particularly what's known as an EMI scheme. So I'll touch on that a little before handing back over to Robin to talk about one area, share buybacks, where things can and do go wrong, and really it's about flagging those issues and making sure that they're avoided as part of that transaction, before I'll finish the presentation by talking about what is a real hot topic in sort of disposals and acquisitions at the moment, which is employee ownership trusts. So by way of a little bit of background, as Sarah said, my name is Paul Brown. I'm one of the directors here at ETC. For those of you who don't know us, we're a specialist tax consultancy firm, and although we're based in Altrincham in Cheshire, we do operate nationally, and we've got a team that covers all of the main aspects of tax, and we focus just on providing that tax advice, typically to own and manage businesses and small and medium-sized enterprises. But enough from me for now, and I'll hand over to Robin to introduce himself and then take you through the first part of the presentation.
Yeah, thanks very much, Paul, and thanks everyone for joining us this morning. I'm Robin Hastings. I'm a corporate partner at Bermans Solicitors in Manchester. My team deals with everything ranging from mergers and acquisitions of companies of all shapes and sizes. And we deal with investments, so whether that's private equity or venture capital, and then to more of the day-to-day stuff like shareholders agreements, employee share schemes, corporate governance matters, and everything in between, really. So I'll kick us off with part one, preparation for sale. So starting off with some of the main considerations which an owner should be thinking about when deciding to sell their business. The first one, which obviously has a large impact on the nature of the transaction, is how it should be structured, whether this is through a share sale or an asset sale. As in, should the subject matter of the sale be the shares in the company, or should it be the physical assets of the business? So it's properties, contracts, equipment, and other assets. We generally find that this consideration is tax-led, so usually one for the business's accountants to look into. But generally speaking, share sales would be more tax efficient, especially for sellers, due to potential reliefs like business asset disposal relief, whereas a buyer might prefer an asset deal to avoid paying stamp duty and to avoid inheriting any liabilities. From a seller's perspective, asset deals aren't usually particularly tax efficient, as the cash essentially goes into the company itself. The company then has to pay tax on the profits, and then the shareholders have to declare a dividend or wind the company up to extract the cash. Obviously, if you've got some specific or peculiar liabilities which the buyer wants to avoid, or any practical issues like dissenting shareholders, then an asset deal might be the only feasible way of going ahead. Most of the transactions that we deal with, though, involve share sales, although whether it's an asset sale or a share sale will have a big impact on what the buyer focuses on in its due diligence. For example, with a share purchase, a lot of the buyer's focus will be on ensuring that the company's share capital is all in order. Whereas this wouldn't be relevant for an assets deal, and the buyer would be more concerned with things like the process of transferring the employees over and the quirks involved with transferring a particular asset or contract. Aside from ensuring that the structure works for all involved, the sellers are always advised to make sure that the business is properly prepared and groomed for sale. Buyers generally want to do a varying level of due diligence on the business they're buying. So the more a seller can keep everything organised and up to date to fit that process, the better. I won't go into too much detail on these as we're limited for time, but by way of an overview, some of what we see as the key areas which a business should be prepared for are as follows. So number one, company structure and records. Seems so obvious, but you'd be surprised at the number of companies which actually have these in order. Statutory books and registers, a lot of the time they don't even exist and need to be reconstituted. So make sure they're all in apple pie order and everything can be properly documented, particularly for more important items like allotting shares, transfers and shares and changes of directors. The company's registers are the definitive legal record when it comes to shares, not the company's house filings. So strictly speaking, shares don't exist until they've been written up in the books. And likewise, shares haven't been validly transferred until a stock transfer form has been approved and registered by the company in its books. If there's a group structure, make sure this follows through for all of the companies, even if they're just dormant companies. And make sure the company's house filings are all up to date too. So for example, ensure all annual accounts and confirmation statements are up to date, directors' details are all correct, and any other important changes all noted. Strictly speaking, board minutes of all major decisions should also be kept, so ensure that these are retained with the company's books too. Number two, share capital. So I could spend all day talking about some of the absolute messes we find some companies' share capital in. For example, when shares were meant to have been transferred, but there aren't any stock transfer forms to back it up. Or when someone thinks they've been issued shares, but the correct process hasn't been followed. The only way to transfer a share is through a stock transfer form, nothing else. So if shares need to be transferred, make sure there's the correct form to evidence it and the share certificate issued too. Things like emails or letters or even agreements by themselves don't serve to transfer the shares, and neither does just noting the transfer on company's house. Another common one we see is where the company wants to issue different classes of shares to give flexibility on declaring dividends between the shareholders, but doesn't actually include the right to do that in its articles of association or in a shareholders agreement. And this can cause a range of tax issues for the sellers. Depending on how old the company is, there should be a fully documented record of its share movements, especially if there were shareholders in the past who aren't part of the sale in question. The take-home point is that a buyer will always want a good route of title to the company's shares, so we'd always want to ensure that any movements are fully documented and actually signed too. Number three, finance. In our experience, it takes weeks to get a bank mandate changed on a sale. So make sure the process with the bank starts as early as possible. Likewise, if there are any loans or other finance agreements in place, whatever's happening with those should be agreed at an early stage, whether that's paying them off before or after completion, or if you need some sort of change of ownership consent from a lender. Getting a bank to release security also takes a long time to process. So if there is any security registered, get this either discharged or a conditional release sorted as soon as you can. Number four, contracts and trading. Generally, when we're acting for buyers, this is one of the main ones which we'll spend time scrutinising. We'd always start by requesting copies of all written contracts which the company currently has in place. Obviously, for larger companies, we could limit this to its main customers and suppliers, but it really does depend on the nature of the business and the spread of its customers. Obviously, a lot of the time, orders are transacted based off standard terms and conditions, so we'd always ask for a copy of those. And we'd always want to know about any unwritten agreements, like if there's any rebates or commission arrangements in place. But the main point here is that the business should always aim to have its main agreements in writing and make full copies available. You'd be surprised at the amount of times we're essentially sent unsigned drafts of contracts with track changes still on them, which just creates a grey area on what's actually in place. Likewise, change of control clauses. We'd always want to know if a customer or a supplier could terminate an agreement if the company's ownership changes, and also if there's any ongoing disputes with any of its main customers. Number 5, company assets. It seems obvious, but always ensure that your assets list is maintained and up to date. So include any buildings, properties, stock, motor vehicles, and also the current valuations. And also confirm how you generally value stock and work in progress, because we find that a lot of the time it's something which gets heavily debated in the purchase agreements. Litigation and disputes. Hopefully the rationale here is fairly obvious, but is the company suing anyone or being sued, and how problematic could this be for the buyer? We don't generally come across companies being sold which have massive ongoing issues, but we'd always want to be given chapter and verse so that we can decide on how it should impact the transaction. So get that sorted as soon as possible and be upfront with the buyer about it. Number 7, property. A buyer would always want to know that the business has got a right to trade from where it needs to, whether that's a case of owning the freehold or having a lease or a license for its premises. Obviously, we want to know what the terms are, such as rent, length, and any service charges. But a lot of the problems that we find are usually around, for example, there being no written lease, or it's with the wrong entity, like one of the shareholders personally, or it's already expired. So again, get this properly documented early on so that we're not having to deal with third-party landlords as part of the deal. Employment. A buyer will always ask for a schedule of employees and directors, and also any consultants, temps and agency workers, so that it knows what the company's committed to on things like notice periods, salaries, bonus and commission structures, and also ask for copies of employment contracts, mainly to ensure that people actually have one and that the key people are properly tied in. Buyers also like to ensure that the company has all the statutory workplace handbooks and policies in place. So make sure that you've got something there to cover things like health and safety and anti-bribery policies. Pensions, again, the buyer would always want to know what the company's committed to in that regard, and to make sure that it actually offers something to comply with auto-enrolment. Number 9, IP and IT. Of course, the importance varies dependent on the nature of the business, but generally, we want to check that the company actually owns or has valid licenses for its main software and hardware. In particular, if there's anything bespoke or really important to the business, we'd want to ensure that the company has that all protected. For example, that it's been properly assigned from whoever created it, and that there aren't any challenges or disputes to the underlying IP. So possibly get confirmatory IP assignments from the developers to ensure that the buyer isn't going to inherit any issues on the ownership of the IP. Number 10, so just quickly, regulatory issues and industry consents. So for example, do we need permission from anyone like the FCA, the CQC or HMRC? Again, in our experience, these can take months to get. So if something will be needed, always flag this with the buyer at the start of the process and make sure that you actually know what the process is, so that once the parties know that they'll be proceeding with the sale, they can jump straight on to getting the applications in. That's part one concluded. So we'll hand back over to Paul. I think he's going to take us through EMI schemes.
Thanks, Robin. So I think Robin mentioned there about sort of making sure that your key employees are tied in, and when a buyer's looking at your business, I guess one of the things that they're going to place a lot of value on is the key employees. They want to be able to have that business up and running on day one when they take it over, but also you want to make sure that those key employees are incentivized and really helping you to drive the business forward towards maximizing your value at exit. So the enterprise management incentive scheme is quite a neat way to actually tie some of those employees in by giving them a real feeling that they're actually going to get some benefit out of an ultimate exit as well. So in very broad terms, an EMI scheme is what we call a tax advantage share scheme aimed generally for key employees. Tax advantage, I'll talk about what that means in more detail, but essentially if you just gave your employee free shares in the company, then the taxman says that that's no different really to paying them remuneration equal to the value of the shares, and they'll tax them on those, which suddenly makes what is a free share not actually free to the employee. So the EMI scheme is really aimed at providing you a mechanism to get some value to those employees in a tax efficient way. And what essentially happens is that the employees granted options to acquire shares in the employment company at some future point. So they don't become a shareholder straight away. They just have a right to buy shares in the future. And the trick with the EMI scheme is that the price that they pay is set at the time that they get this right, to acquire the share, which means that if they can buy that share at £1 and then sell it at 10, then quite clearly they're going to end up with quite a significant benefit as a consequence of that. And essentially the way the scheme works, provided you set it up right, is that the individual doesn't get taxed at the time that they get the option to acquire the share. They don't even get taxed at the time that they acquire the share. They essentially only get taxed when they sell the share. And as a nice little bonus, and assuming it still exists in the future, then the employee can access business asset disposal relief, the tax relief formerly known as entrepreneurs relief, on the sale of their shares, provided they meet some time limits. So why would you think about an EMI? I think that the key thing really is that the employee sees that there's a clear link between their future reward in terms of potentially sharing in the proceeds of sale and their contribution to the business. So they can see some real upside and some real link. There are significant tax advantages for the employees, as I've just said. Essentially, they get something which is taxed at capital gains tax rates rather than paying income tax. And the current rates, if you can qualify for the entrepreneurs relief, that could be the difference between a 10% tax rate and a 45% tax rate. It's also very flexible, so you can design the scheme really to suit your needs, and we'll touch on how you can do that in a little bit more detail. But it's also important to note that there are some specific conditions that still need to be met. And again, we'll touch on those at the moment. You can flex when people are able to exercise the options. So when they're actually able to acquire the shares, it can be sometimes time-based. It can be based on performance criteria. Or in a lot of cases, what we typically see is that the employee can only effectively buy their share immediately before a sale. It prevents a lot of issues in terms of having minority employee shareholders, but what it also means is that effectively they can pay the price that they need to pay to buy the shares out of the proceeds that they get from selling it. So as I say, the employee doesn't become a shareholder immediately, so they're not entitled to dividends. They don't have any voting rights in the company and so forth. But it does give them that ability to see that there is some pot of gold at the end of the rainbow for them. And as an added benefit for the employer, there's effectively the employing company can get a tax deduction for effectively the difference between the value of the shares when the employee acquires them and the price that they pay. So there's a nice little kicker for the employer there in terms of a little bit of a corporation tax saving. Probably the key thing really, the initial conversation is how do we actually structure this option? The first question really is who are the participants in the scheme? And then what percentage would each option holder receive as part of their options? Now, typically you would expect that to be a relatively small percentage. We've seen them in instances where people get rights to buy 1%, 10%, sometimes as high as 20%. There's a maximum of 30% that they can actually acquire under the scheme. You can put performance criteria in there, but that's not essential. Sometimes it is literally just a case of, well, you know, you're still here at the time become the option, the option becomes exercisable and you're entitled to get it as a consequence of that. As I say, when will they be able to acquire the share under the option? That's a key decision. Are they going to become shareholders at some point, or is it really only at the point of sale? The exercise price is the point I've just touched on. That's the price that they have to pay to acquire the share. And that's actually set at the time that they actually acquire the option. And that's the price that they pay when they acquire the share down the line. Now, that's quite a significant pressure point in terms of how the scheme works. And I'll touch on that in a little bit more detail later. Other things you might want to include what's known as good leaver and bad leaver provisions. Generally speaking, if an employee resigns, you don't want them to have the ability to acquire a share in the future. So typically the option would be cancelled at the point that they leave. And if they become shareholders, and Robin touched on this in his section just before, if they become shareholders, you really want to make sure there's a shareholders agreement in place as well. So there's a few kind of upfront things that you need to think about before you go too far down the line in setting the scheme up. I think that there can be a perception that actually an EMI is a pretty straightforward thing to do, and you know, effectively it's a fairly standard document, and you don't need to worry too much about the tax position because it's all, you know, it's all pretty much bog standard stuff. But actually, there are a few areas where things can and do go wrong. But also there's a question that you need to ask yourself right from the outset. So the idea is that essentially, if you give an employee options over 10% of the shares in the company, does that mean because of their improved performance, the 90% that you have left is worth more than the 100% would have been if those employees hadn't had those options and would have been more motivated? And that's your key question, really, if you're going down this road. It's also important, I think, to communicate to the option holder. We've seen schemes implemented where the option holder hasn't understood it. They really don't know what the benefit is for them. And as a consequence, they don't value it. And you pay to put a scheme in place, but you don't get any payback on that because it doesn't really, impact on the employee's mindset at all. So communication is really important. The exercise price, I've mentioned this a couple of times. For the scheme to be tax efficient, the exercise price, which again is the price that the employee has to pay to acquire the shares, it can't be any less than the market value of the share at the time they get the option. The issue with that is if, let's say, the share was worth £5 at the time they get the option, but you say they only have to pay £1 to acquire it, the difference there, that £4, means that they would potentially not pay capital gains tax on all of the proceeds of selling the share, but they might have an income tax liability at the time that they actually acquire the share and won't necessarily have the cash to pay it. So getting that exercise price is key, and there is a mechanism to agree that with HMRC upfront. There's another requirement that around employees' working time requirements. It seems self-evident to say they have to be employees, but they can't be contractors. They have to actually be employees, but they also have to, if they're full-time, work at least 25 hours a week on the business of the company, or potentially if they're part-time, then it can be less than that, but it still needs to be 75% of their working hours. So it's not necessarily just as easy to say, well, it's anybody that we can get to join the scheme. There are some requirements that you have to meet. If they don't meet those requirements, it doesn't qualify. They don't get the tax benefit. The company has to have certain specific types of activities in order to qualify. And it's more defined by what you can't do than what you can. So there's a list of activities which, if the company is in certain trades, then it can't qualify for EMI options. Unfortunately for us, people who provide accountancy services or legal services don't qualify for EMI schemes because apparently they're considered to be low-risk businesses. So I'm not sure whether I wholly agree with that, but there you go. I think it's also important to understand it's aimed at smaller companies, so there are limits around the amount of assets a company can have and the number of employees that a company can have as well when they implement the scheme. If you're putting performance criteria in place, I'd say make them as objective as you can be. Don't make it, Fred or Jane's got to be a nice person, or, they've got to be friendly to their colleagues. Really make it objective so there can't be any argument as to whether they've met them or not. Something I'm sure dear to Robin's heart, don't recycle old paperwork. I've seen situations where people have said, well, all we need to do is use the same paperwork from 2 years ago and that'll all be fine. But then ultimately the rules have changed in the intervening period and the options aren't valid. And so the employee ends up rather unhappy because they don't get the benefit of the tax benefits. Things can change over time, which means that the options don't qualify anymore. Typically, that would be if the employee leaves, for example, or the company's business changes, so it doesn't qualify under those. That can mean that the tax benefits effectively stop at the time that the change happens. The employee's only got 90 days to acquire the share, then otherwise part of any gain they ultimately make will be subject to income tax. So that's really something. It's not just a case of a fire and forget thing. You don't put the scheme in and then forget about it. You've really got to be aware that any changes could impact on it into the future. And I think one of the big things as part of a deal and part of the tax planning around the deal, if the employee can only exercise their options at the time of the deal, the tax deduction the employer gets can be quite significant. It's really important to make sure that the paperwork on the deal actually makes sure you as the seller gets the benefit of that tax deduction rather than it going to the buyer. And the last piece from me on this section, before I hand back to Robin, you have to tell HMRC you've issued these options. If you don't tell HMRC, they don't qualify as EMI options. Now, the rules are changing at the moment. If you issue options today, you've got 92 days to tell HMRC. The time is going to be extended from 6th of April, but it's such a key part of it, and it's the detail that really does catch people out. You don't tell HMRC, it doesn't qualify, the employee doesn't get tax benefits. So that's why making sure that you're getting advice from start to finish of the process is really, really important. So that's a pretty quick run through, and don't forget to pop your questions in the Q&A box if there are any on that, and I'll hand back to Robin for his next section.
Great, thanks, Paul. So part 3, share buybacks. What are they and why can they be an issue when selling a company? So in short, they're a method of cancelling shares and returning value to a shareholder. For example, when a shareholder retires from the business or ceases employment and needs to return his shares, or simply to adjust the percentages that the shareholders hold. The Companies Act 2006 prescribes the procedure for carrying out a buyback, and if there's any departure from this, then the courts have been quite robust in saying that this would result in the buyback being void, potentially leaving an unwanted rogue shareholder. When you're coming to selling your company, the last thing you want is there to be someone still holding shares who shouldn't have them. But unfortunately, it's something that we see fairly frequently. And trying to sort that out alongside doing the actual deal is far from ideal. So what circumstances could render a share buyback void and potentially leave a company with an unwanted shareholder? Some of the more common ones. Number 1, lack of distributable profits to fund the payment. The vast majority of the share buybacks we see are funded this way. There are a couple of exceptions where the company funds the buyback out of its share capital, which is a very long-winded and rare process, or out of cash, which is limited to very small percentages and payments, so wouldn't be used for funding the exit of a fairly major shareholder. Unless it's carried out through the share capital or de minimis cash route, the general position is that if it's done with insufficient reserves, it's automatically void and hasn't been carried out. So always check that the company has sufficient reserves at the time of the purchase to cover the purchase price in full, and ideally append accounts to the board minutes approving the buyback so that it won't get questioned in the future. Secondly, probably the one that we come across most is that the purchase price isn't paid in cash in full at completion. A few examples of the cases that we've seen, leaving the purchase price as an outstanding loan account, paying it at some point after completion, paying it in instalments, not paying it in cash, and including an anti-embarrassment clause, so saying that the company could have to pay an uplift on the purchase price if it gets sold in the future. There seem to be court cases on these examples going back to when buybacks first started, and the message is still the same. If the purchase price isn't paid at completion, then the buyback's void in its entirety. And thirdly, lack of documentation and authority. Again, these are fairly usual occurrences when it comes to looking at historic buybacks. The basic procedural requirements for a share buyback are, firstly, the shares must be fully paid up, so not nil paid or partly paid up. Again, deviating from this will also void the buyback. There needs to be a written share buyback agreement between the company and the shareholder. The company's articles must not prohibit buybacks. The purchase contract must be approved by a resolution of the shareholders, usually an ordinary majority, and the selling shareholder isn't permitted to vote on this. And finally, stamp duty needs to be paid to HMRC, and you then need to file Companies House Forms SHO3 and SHO6. Some potential solutions which might help save or rectify a faulty buyback. Firstly, rely on the duomatic principle of unanimous consent, which is essentially demonstrating that even though something wasn't signed, all the relevant parties demonstrated that they were in agreement with it and acted on it. This could be useful for solving a lack of formal authority, like if the shareholders' resolution wasn't signed at the time, but it can't rectify, for example, lack of reserves or there not being a written buyback contract. The second option, accept that the buyback was void, so hasn't happened, and carry out the buyback again, this time using all the correct documentation. Of course, the problem with this is that it only works if the shareholder's still available and willing. Where you might run into problems is if you can't locate the shareholder anymore, or if they left in acrimonious circumstances, and approaching them to redo it would pose problems. Assuming that the shareholder is okay to redo it, would typically approach it on the basis that the original payment gets treated as a loan, so this would need to be repaid to the company, then repaid to the shareholder on completion of the redone buyback. Depending on how long ago the initial payment was made, you might then look for the other shareholders to indemnify the exiting shareholder for any adverse tax consequences of it having been treated as a shareholder loan. Then finally, for completeness, make sure all the filings are done correctly, so including paying stamp duty and potentially having to pay it again if the original buyback was void. Thirdly, a reduction of share capital. So similar to a share buyback, but you essentially pass resolutions under a separate part of the Companies Act in order to cancel the shares in question. So this is more appropriate when the shareholder in question can't be located or just wouldn't cooperate with getting the buyback redocumented. For example, if they were forced to leave the company and had to relinquish their shares as part of a settlement or under leaver provisions. Essentially, there are two ways of doing a share capital reduction. Firstly, the solvency statement method, under which you need all the directors of the company to sign a solvency statement, confirming that the company is solvent and that the cancellation of the shares in question wouldn't result in the company becoming insolvent and thereby prejudicing any creditors. You'd also need a special resolution of the shareholders in order to cancel the shares. And because the original or the rogue shareholder would have already been removed from the register of members, the company wouldn't therefore need to involve them in the resolution process, which is a risky approach if the shareholder ever got wind of it, but it seems to be becoming more popular as a way of resolving void buybacks. And the second method, which is generally seen as a far less risky solution, is a reduction of capital approved by the court. This is usually seen as a better approach, particularly if you're selling the company, because the court issues a certificate of reduction, So effectively rubber stamps the cancellation without the involvement of the shareholder in question. Whilst it's more conclusive than the almost unilateral way under the solvency statement route, it is, of course, far more expensive because there would be court and barrister costs involved. But for larger companies looking to sell, sometimes it's the only really safe option. So the main takeaway points in relation to buybacks. Firstly, make sure any buyback funds are paid in full at the time of the buyback. So all in cash with no deferred payments or leaving as a loan account. Secondly, distributable reserves. Always check that the company has enough to fund the purchase price. Obviously, you can still use bank loans and other sources of finance to fund the payment itself, but your accounts still need to show that the company has sufficient reserves. And finally, always use a lawyer and an accountant for any share buyback, even a really simple one. They can ensure that the correct documents are used and that the correct procedure gets followed to avoid any risk of it potentially being void. And on that note, if any of the items discussed have set any alarm bells ringing in relation to any historic buybacks, feel free to get in touch. I'll be happy to have a look through the paperwork if it helps set any minds at ease. That's part 3 concluded.
Thanks, Robin. So the final part of the presentation before we move to questions is really focusing on an area which has become increasingly popular amongst business owners looking to exit their business, which is employee ownership trusts. Some of you may well have heard of EOTs, but for those who aren't familiar with the concept, essentially it's a method by which the ownership of a company is held for the benefit of all employees. And I'm choosing my words very carefully there for reasons I'll explain in a moment. The concept was introduced in 2014 really to encourage employee ownership, because it was felt that if we encouraged employee ownership, then it would drive productivity. And I think we're all aware that sort of national productivity continues to be a real challenge for the UK economy. So why was I saying they're held for the benefit of our employees? The employees do not actually own the shares in this structure. The shares are held by a trust, which, as I say, holds the shares for the benefit of the employees, but the employees aren't shareholders. They're not on the shareholder register. Implementing an employee ownership trust brings tax breaks for the business owners, but also for the employees. So again, part of the reason it was introduced was to kind of give people a little bit of a tax incentive to go down this route because of the wider benefits it might bring the economy. And just to emphasize, I think this is absolutely a statutory structure. It's within the law. It's not in any way, shape or form a tax avoidance scheme. I think sometimes the revenue are very good at saying if something sounds too good to be true, it almost is. Well, there's a danger that employee ownership trusts sound like that to a certain extent, but actually it is a well-trodden path. It's a perfectly legitimate structure. So I guess before we think about the tax, specifically, why would people go down the route of getting an EOT? As I say, I think there is evidence, and I'll talk about that in a moment, about the fact that employee ownership trusts do drive productivity because you end up with a more engaged and motivated workforce. It also helps to protect that hard-won legacy from the business owner. They've worked over many years, and I think often when we get to an exit with a business owner, it's as much about making sure the business is preserved into the future as it is about maximising the amount of cash that they walk away with. And an EOT certainly I think does work to achieve that. It also allows a kind of a phased process of leadership succession, because the business owner can stay involved in the business. They can continue to own shares in the business. They can continue effectively to run the business at an operational level, allowing them to bring through that next level of management to enable them to take the business into the future. The structure allows business owners to access the value that they have created over time. It is an exit route. They do get paid for selling their shares to the employee ownership trust, so it allows them to take that value off the table. From an employee point of view, once you're in an employee ownership trust, the employees of the company can get a tax-free bonus of up to £3,600 each per year. So a nice little sort of tax-free kicker for the employees. It doesn't have to be 3,600. It can vary, but it has to vary based on objective criteria rather than, for example, performance. And I think it's important to emphasize that doesn't mean that you can't pay any other bonuses under the structure. The 3,600 limit is just the amount that you can pay tax-free. And the last item there, from a business owner's point of view, if they sell their shares to an employee ownership trust and they meet the conditions to sort of fall within the rules, then any capital gain they make on selling those shares to the employee ownership trust is actually capital gains tax-free for them, as I say, subject to conditions. Now, I've consciously left that bullet to the last there because I think if that's first and foremost in a business owner's mind is they're only selling to an employee ownership trust because they're making a tax-free capital gain, I think there's a real risk that they're doing it for the wrong reasons and that potentially it might store up problems for them down the line. So they really need to look at it in the round to make sure that an employee ownership trust is the right thing, not only for them, but for the business as well. A few stats around employee ownership trusts. So I think at the last count, 31st October 2023, there's something in excess of 1,600 businesses have now gone into employee ownership trusts. And I think the pace at which these sort of structures are being implemented is really increasing. So as it says there, 330 of those 1,650 came in the last 12 months. And we're certainly seeing a lot more inquiries and a lot more business owners. And I'm sure Robin's seeing the same. People really interested in this structure for a variety of reasons, but the interest is definitely increasing. If you look at kind of how employee ownership has impacted on businesses, of those businesses that kind of reported, 57% have reported that profits have increased over periods prior to employee ownership. And, you know, pretty significant number, 83% reported increased employee engagement and 73% reported increased job satisfaction. I think it's no coincidence that if you get those sort of numbers in terms of job satisfaction and employee engagement, it kind of is likely to lead to sort of better profitability for the business. So what are the key things to think about if you're implementing employee ownership trust and, you know, focusing to a certain extent from a tax perspective, but also thinking more broadly as well? So what happens is the shares that are sold to the trust, they're sold at market value. Now, obviously, market value is kind of something that needs to be defined, and you absolutely need to get an independent valuation, because if the taxman thinks that you've inflated the valuation to try and maximize the benefit that you get from that 0% capital gains tax rate, then they're going to be all over you like a rash, I'm afraid. So that is a non-negotiable in terms of getting what is a really robust independent valuation of the shares. The real key thing, though, is that control has to pass to the trust. So the business owner in selling to the employee ownership trust is giving up control of their business. So that means not just more than 50% of ownership, but also voting rights. If the company sold 50% of the more than 50% of the proceeds would have to go to the employee ownership trust. So I think as a mindset thing, that's something that, you know, people considering this really need to get their head round early in the process. It's also important to be aware that whilst there is an upfront tax benefit, if the employee ownership trust goes below that magic sort of control level of having more than 50%, then the tax benefits that accrued on the original sale get withdrawn. In the short term, in the first sort of tax year following the sale, if the control sort of falls away from the employee ownership trust, it's the business owner who pays the tax. After that time, it's the trust that pays that tax. But given, as I'll talk about in a moment, quite often the business owner is relying on future cash generated by the business in order to pay some of their consideration, then having a big chunk of that going in tax being paid by the employee ownership trust is really not going to be a good outcome from the business owners. So it's really something, this is a long-term structure. It isn't something that you dip into and dip out of. Once you're in it, you've got to stay in it. Otherwise, you end up with a nasty tax bill as a consequence. As I mentioned, employees can get benefits, but there isn't really a way to kind of distinguish, as I say, based on subjective matters like performance. They've all got to be included, and they've all got to be included on the same terms. You can vary it to the extent that it relates to, for example, seniority or other objective factors like that. But once the employees are in, it is for the benefit of all of the employees. As it says there, you can vary that bonus depending on their level of remuneration, length of service, but there's very limited criteria you can use. And generally speaking, the employee, the former owners aren't able to benefit from the trust once it's implemented. So how does the employee ownership trust get funded to pay the employer the business owner their consideration? More often than not, there will be cash in the business, and that can be used by the company to fund the employee ownership trust to pay part of that consideration for the business owner up front. But more often than not, what we see is actually an element of that cash is actually deferred and paid effectively out of future cash that's generated by the business. And this is one of the reasons why most often the business owner will want to stay involved, because they want to keep an eye on things and make sure that the business is actually going to continue to run successfully and is going to generate the cash. There are instances where people go and get third-party funding to pay that upfront consideration for the employee ownership trust, and funding is available, and some of the main banks will actually fund these transactions, but it's not the most common approach. It's also important, I think, to note that the company continues to be run by the management team, which can include the former owners. The employee ownership trust does not run the business on a day-to-day basis, but it is also there in the background. And it's important to understand the role of the trustees in that situation. What's really interesting, I think, is that kind of concept of the role of the trustees is really evolving over time. And I think even though they've been around since 2014, that kind of interaction between management and the trustees is really still something that's subject of an ongoing debate. And that's why knowing who the trustees is going to be is really, really important in engaging with people who are going to be trustees early on in the process to understand how the relationship is going to work. There is a consultation with HMRC at the moment, because, if I'm brutally honest, some people in the early days of these structures, they kind of said, well, okay, the two business owners who sold the shares are also going to be the two trustees, thinking that, well, we may not legally control it anymore, but we can practically control it, because effectively we're the people who are running the show both as trustees and as management. The revenue, unsurprisingly, aren't particularly thrilled by that. So there was a suggestion that there was going to be an obligation to have an independent trustee. But I think as a matter of best practice, having an independent trustee as one of the trustees is absolutely the way to go with this. There is a slight difficulty, or not difficulty, there's a potential challenge around the payment of dividends. So if the employee ownership trust has some shares, but the former owners keep some of their shares, then they may want to, the former owners may want to pay dividends themselves. Dividends getting paid to the trust is not particularly tax efficient. So often people will kind of waive, or that the trust will waive its entitlement to a dividend, so as that we don't create a big tax bill inadvertently in the trust. Most often, it's probably fair to say the business owners will retain a stake, and that can be anything from 49% down to 10, 5, or even 0. You can sell in the entire business. I think the first thing to note about that is, the initial sale is a one-hit wonder. The tax benefit is only on sales in the same tax year as the first sale. So if you sell to the trust later, you pay ordinary capital gains tax rates. But also, if you retain a stake, you have to ask yourself, well, what am I going to do with that in the future? Is this going to cause me an issue if I want to sell those shares down the line? Is anybody going to want to buy those shares without buying the shares in the trust? And I think, again, although these things have been in place for a while, they are intended to be long-term structures. So we haven't seen that many instances where an employee ownership business is sold. So keeping those shares as a kind of, well, I'd like to still keep an interest in the business, you do have to really think about what that means in terms of that longer term position for you. And that links into the tax position on the sale of the shares. So if the trust sells the shares, then effectively the gain that the original business owner made on the shares kind of gets taxed on the trust as well at that stage. So it's almost better to think of it not as an exemption, but as a deferral of the tax. So what that essentially means is if the business owner only paid £1 for the shares from the outset, when the trust comes to sell its shares, it may have paid £10 million for those shares in the original transaction, but from a tax point of view, it's only treated as having paid £1, and the full amount of the tax on that gain that gets paid out of the proceeds by the trust. And there's also a big question about what happens to the proceeds after the sale. Does it go to the employees? If I'm a buyer and I know that the employees of the employee ownership owned business are going to get £500,000 each, I'm going to be pretty concerned that they may all decide to leave and the business that I've just bought hasn't actually got any value left at all. So it's really important, you know, to think about what it all looks like in terms of that future exit. It isn't just getting it right now, it's also thinking about the future as well. Conscious of time, I think that's it from me. Sarah would shout at me if I didn't mention that we've got sort of 3 more events, which are kind of doing a bit more, are going to be doing a bit more of a deep dive into some of the sort of matters that we've talked about with Robin today. The details are there, and obviously you'll get the slides in due course. But without further ado, thank you very much for your attention. Obviously, you're all blanked out, so I can't see whether you're all still there or not. Hopefully you are, and you've enjoyed the presentation. And over to Sarah, if there's any questions in the Q&A box, please.
Yes, we've got a few questions here. So the first one is, with regards to EMI schemes, does there need to be a formal valuation of the company approved by HMRC at the time of grant of the option?
That it's not a requirement to agree the valuation with HMRC, so you could potentially proceed on the basis of a valuation that hasn't been agreed, but I think we would always recommend that you do agree the valuation, because what you don't want is to get to the point where the employee exercises the options and at that point HMRC comes along and says, well, actually, we think you've undervalued the shares. They should have been worth a lot more, and therefore that employee who thinks they're only going to pay capital gains tax when they sell the shares is actually going to have an income tax liability. So it's more you could say it's more of a belt and braces thing. I think the other thing I'd say is that HMRC tend to be fairly relaxed about EMI valuations. I mean, they look at them, you know, don't make any mistake about that, but they're also not typically going to really nitpick about the valuation. So there's probably no downside. I think there is a real upside to getting the value, because it just gives you that sense of security and comfort going into the future.
Okay, thanks. And we've got another one that says, what are the considerations, provisions, if any, for a company which has already gone through an EOT and subsequently gets approached from a buyer, e.g. a larger trade acquirer?
I think you know, potentially I touched on a few of those there. I mean, it's really, first of all, understanding what the tax position is going to be on a sale. It's thinking about, you know, how the proceeds are going to be dealt with, because a big chunk of the proceeds will go into the trust. What does the trust do with that? Does it distribute them to the employees, or does it actually, and I've seen this in certain instances where effectively it says, well, any proceeds after tax get paid into a charity, for example, so the employees don't benefit of it. It's an interesting one, but I have seen that done. But it's also the practicalities of making sure that the trustees are on board, because they're the ones who are going to presumably have to sign the sale documentation. Robin, probably better placed than me to comment on that. But it's just the logistics of having the trustees on board. Do the trustees think that the sale's in the best interest of the employees? Because that's ultimately their duty at the end, is to make sure that, you know, the trust is holding the shares and that effectively the business is being run for the benefit of the employees. So I think it just creates a few practical considerations, as well as looking, you know, at the more technical aspects on the tax side.
Another one is, let me just scroll down. With an EOT, will the new employees post the EOT being implemented be automatically be entered into this?
So I guess, yeah, I mean, if effectively, as I say, the employees aren't shareholders, but the trust is run for the benefit of all employees. You know, I've seen instances, and I have to admit it's something that escapes me immediately. But I think there may be certain situations where it might be that they're excluded for a period. Is it 6 months? I'll double check on that and revert, because that's, you know, I have to admit I don't quite remember the answer. But typically, you know, once they've been there, I think it might be while they're on probation, they might not necessarily be covered, but once they're permanent full-time employees, then effectively, or, you know, even part-time employees, they would be part of the arrangement. But I'll double check that, and we can send more details out on that with the notes.
Perfect. Have you seen or know of any companies that have been bought out of an EOT?
I think, as I said, no, personally, I haven't, and I'm not aware that there have been that many. I'm sure there possibly have been some, but certainly, I'm not aware of any, and there isn't really a body of knowledge out there that kind of talks about how that might work. And as I say, I mean, I think the reason it was set up in the way that it was is because the objective is really to make this a long-term structure. It's to keep that business being employee owned into the future, which is why actually the tax position on a sale, certainly for the trust, is potentially quite penal. So not something I've seen. I would be surprised out of 1,650 if some haven't been sold, but and Robin may have seen some instances where it has happened, but I think it is still probably quite rare.
I've got a couple more questions before I finish. Robin has given some great insights about the legal side of a share buyback, but what are the tax implications for the shareholder of a share buyback?
Well, that's a really interesting one. So without boring everybody, effectively the default position from a tax point of view on a share buyback is that anything over and above what the shareholder subscribed for the shares should be treated as dividend, which makes the whole thing very, very tax inefficient. Now, there's a set of provisions that sits over the top of that says if you tick the relevant boxes, then it's treated as a capital gain on the sale, and the employee would pay capital, or the shareholder rather would pay capital gains tax rates. But it is very much, there's a set of prescriptive conditions, and if you fail on one of them, then you don't get the capital treatment and it is taxed as a dividend. So the main ones, you've got to have held the shares for at least 5 years. The company's got to be able to show that the share buyback is for the benefit of the trade of the company. And importantly, the company has to be a trading company. So if it's an investment company, then the capital gains tax treatment won't apply. And so it does become quite tax inefficient for the shareholder. There's alternative approaches, but it's really important, I think, to understand these. And actually, there is, first of all, a mechanism to get clearance from HMRC to say that, yes, it will be treated as a capital gain. But also, there is actually a requirement to report the transaction after it's been completed in order to make sure it does get that capital gains tax treatment. But, I think Robin quite rightly said, don't do it without accountants and lawyers. Don't do it without tax advice, because it could lead to a fairly unfortunate outcome and, a very unhappy departing shareholder if they're expecting to pay 10 or 20% tax and they pay 39% tax instead.
Perfect. And finally, are there any alternatives to EMI schemes if a business wants to give shares to employees?
There are. You can just give employees shares straight away, but as I say, the value of those shares is effectively taxed as employment income. There's another structure which is known as a growth share. So this is a structure where the employee becomes a shareholder straight away, but that share effectively only entitles them to any future increase in the value of the company. So if the company's worth £1 million at the time they get the share, then they only get any value if the company's value increases over £1 million. That first £1 million stays with the original shareholders. And the argument there is that means that the growth share is only a very limited value. And so the tax consequences for getting the share without paying for it are a lot less than they would be if they'd just been given a free share. For companies that don't qualify for EMI but want to do something similar, there's a company share ownership plan structure, but that's a lot more involved, and the limits in terms of how much benefit the employees can get is significantly lower. So it is very much a horses for courses thing, really. Growth shares work for some businesses, some, depending on what they're trying to achieve, as opposed to EMI. I think if it's about retaining people with a view to an exit down the line, the EMI does have a lot of attractions though in that situation, but there are definitely alternatives if people need them. So.
Perfect, thank you. I think that's everything. So as Paul mentioned, please look out for the early bird offers on the rest of our webinars coming up this year. If you've got any further questions, please get in contact with us and enquiries@etctax.co.uk, and we will be sending the slides and the recordings out within the next week. Thank you everybody for attending, and thanks gents for a fabulous presentation.
Thanks, Sarah. Thanks,
Thanks very
everybody.
much, everyone.